in the country of source, or sorry, in the country of, but that amount is taxable in the country of residence because it is for future employment. But in case they have garbed it or they have clouded it, because they have also brought in this clause saying that if the payment does not make any real difference to the ex-employer, it will still be taxable in the country of source. And I'll give you an example where a person who is actually very much instrumental in getting business for a company, he is an employee. That employee, say, let's take an example that that person is an Indian resident, goes and works for a UK company, does a marketing, he earns a huge chunk of money for the employer. Now the employer, he is terminating his employment. The employer signs up an agreement with him saying that yes, you are not supposed to work with any other competitor in UK for the next 4 years. That person is anyways coming back to India. And that employer who is there, he is not bothered because he is having a monopoly kind of an article, for example, monopoly kind of sales. Then that person, it makes no difference for that UK employer whether he is paying him or not. But this clause is used to avoid payment in this country of source. To avoid paying tax in the country of source, this clause is used by a person who is anyway supposed to get retirement benefit. He said that no, you don't give me retirement benefit, you structure it as if you are paying me for for not competing against you or not joining your competitor. And that's why let it get taxed in my country of residence, I don't want it to be get taxed in UK. But then in those kind of cases, it will still be taxed in UK. That is what the commentary has clarified. After all this discussion, what the issue remains on a practical ground is that there is a difficulty for claiming tax credit. And frankly speaking, the simplistic kind of condition, which we had a client who was working for a US company, and obviously he was there for for 8 months, 4 months used to in India. It was very well structured. Their companies, the group at the same companies, both ends. They said that whenever you work in India, we'll pay you salary in India. When you're working in USA, we'll pay you salary in USA. Nothing wrong in it. He is actually earning salary in the country where he is actually rendering service. Unfortunately, when his US taxes were deducted and he had to come in India, he was a resident of India, he paid his taxes and claimed credits. Problem was that the tax officer, he said that no, I don't understand this. You won't believe it. He said, I don't understand what's a tax credit. And that's a problem. So we started from there, we taught him what is a tax credit. We reached that stage and finally at the end of the day, he said that no, even my commissioner now doesn't understand it. He is saying that he has not seen this, so we will disallow it, you go into appeal. And this very strictly happens. So you can never say that whatever safeguards you may have kept, but still there will be a chances where you may have to fight to get even simple tax credits. Sorry, you had a question? Yeah. Yeah.
Non-mandatory social security contribution for French expats are taxable.
I'm covering that. I'll just. Now there is another controversial issue which I would just like to take up. I am taking it by way of a case study. Mr. A non-resident, was employed with a Hong Kong company. We are coming back outside of the DTAA. Mr. A non-resident was employed with a Hong Kong company from 1st April 2015 to 31st March 2016. He rendered services in Hong Kong during FY 15-16. So he has rendered service there. He was employed also with a Hong Kong company. But he leaves employment and returns to India in April 2016. Now he is a resident and ordinarily resident from April 2016 onwards. For FY 16-17, he is a resident and ordinarily resident. He receives salary for the month of March 2016 in April 2016. The salary for March is received in April 2016. Till March, he was a non-resident. In April, he was a resident. What would be his taxability of the March salary? He has received it in India when he was a resident and ordinarily resident. Sorry? Taxable, right? Yeah. Prima facie received in India, so you would say it's taxable. Very true, correct. But when it comes to salary income, there is some uniqueness to it. It says taxable on due or received basis whichever is earlier. Now, when you already taxed it on a due basis, you consider it as a situation where you brought it, you consider it for taxation on due basis. At that time, where was he? He was in Hong Kong, a non-resident. If that be the case, then that has already been considered for taxation. He was not liable to tax in India because he was a non-resident. When he is received, can you again bring him to tax in India? If it is in the same year, I would say without doubt what you said, it's taxable. Because in India, you are in the same year, you have accrued it outside India, but you are a resident, you received it in India, it doesn't matter. If you are a resident, irrespective of wherever it is accrued, also it wouldn't matter. If you are a non-resident, still, in the same year, you would have received it in India, you would remain taxable. That is what all the people on ships outside India face this problem. Because in the same year, they have earned it, it has been accrued outside India, but it has been received in India in the same year, therefore what you are saying is right, it is taxable in India. I am talking about different years. I am talking about a year in which first you have considered it on an accrual basis, even though you may have not done anything, you may not file any tax return in India. This is one view where it can be said that the salary accrued outside India when a non-resident, received in India when he was a resident but ordinarily resident. There, salary for March 2016 has been earned on rendering of services outside India for a foreign employer. It is definitely accrued outside India. He was a non-resident, and therefore taxable salary is taxable on due basis in FY 15-16. Even though he was a non-resident of India, otherwise if you read section 15, he was taxable on a due basis. He was a non-resident of India during that period. Therefore, the salary is not taxable on accrual basis. Now, when you receive that salary, can you again say it is taxable on due basis and not receipt basis? Can you say that it is taxable on a receipt basis? In my view, you can take a stand that once salary has been considered for the scope of taxation on an accrual basis, it cannot again be brought to tax in India again on a receipt basis. Mind you, this is there as an explanation to section 5, which says that wherever income has already been forming part of your total income on an accrual basis, it cannot again form part of your total income on a receipt basis. But they are saying about forming part of total income. In this case, it did not form part of his total income. He was a non-resident. He did not submit a tax return in India. But still, I would say that there is a strong ground to say that this person's income for March 2016, when you read it with section 15, it was already taxable on due basis. Once it has been considered for taxation, he was a non-resident, not liable to tax in that year. You cannot again say that on receipt basis, I will bring him to tax again. So, all this, it is very, very relevant when you come to ESOPs. This is, I am talking about 1 month's salary. But when you come to ESOPs or for leave salaries or other areas, so then also it becomes very relevant.
Very technical.
Yes.
When you say
Yes, sir.
Hong Kong employer,
Right, sir.
income has arisen and
Right.
accrued
Right, sir.
in Hong Kong by virtue
Yes.
of 5(2).
Right, sir.
By virtue of 15A, income is due in Hong Kong.
Correct.
So from that analogy, if a non-resident receives salary in India, it can never be taxed.
Never be taxed.
So how it is taxed?
Yes.
As in earlier we have seen that if salary is directly received from an employer who aboard the ship, it will be taxable in India if it is received in an account.
Correct.
Can we not use this analogy which you just explained to us?
So I think what we can do is we can go to section 5.2. 5.1 and 5.2. I'm sorry if it's reading out slightly smaller. But essentially what it talks about, let's go to 5.2. It says subject to the provisions of this act, the total income of any previous year of a person who is a non-resident includes all income from whatever source derived, which is received or deemed to be received in India in such year by or on behalf. So, income of any previous year received in India in such year. Now, if we try to read it together, it comes to a conclusion that it has to be the income of a particular year. Have you received it in that year? You received it in the year later, because as far as section 15 is concerned, you are taxable on a due basis. You have accrued in such year, but it has happened outside India. This stand, I agree with you, is very controversial. In Palkhiwala's commentary, in Palkhiwala's commentary, actually they have stated where at one place they have in fact stated that taxation on a receipt basis is not taken into account as far as salary income is concerned. It's very starkly, really strong statement to make. But they have stated that because section 15 taxes you on a due basis, therefore receipt basis taxation doesn't come into place at all as far as section 5 is concerned, which I feel is taking this same principle to a very much,
It's too technical.
Exactly.
You cannot plan like that.
You cannot plan, definitely. But it helps when you have, you cannot say that for what I have taken is for March 2016 received in April. But when it comes to ESOPs or leave salary which has been earned for many years on end, and those kind of cases, that actually helps. So, this example which I have given, that also helps you, but in a case where you have to take into consideration the ESOPs and those taxation principles. And just rushing it because actually I wanted to clarify on this tax-based tax provisions. This table actually tries to give you where employee is a resident in India, what is his tax liability otherwise in India. Similarly for a non-resident employee, and this what we have already discussed is essentially trying to tabulate that same thing. International hiring out of labor, to just rush it a bit, you have an employer who is his function solely is that of taking employees on contract and hiring them out, or rather giving them out to other to entities who actually require those employees. So there will be an Indian resident who enters into a contract with such an employer, and you pay that employer. You would say that I need say 30 employees or 40 employees or 100 employees or 100 engineers or so and so forth.
You have time.
Okay.
No rush.
Okay, sorry, I thought that we had.
No, we have come up to.
Okay, how much time then
I think you have 10 minutes more at least.
Thank you.
Not 15, but 15 also you can
No,
take
thank
because you started little late.
Yeah.
So I don't want to give you just.
Thank you.
Will you read the previous two slides also? Which was
Actually, I have
Then
tabulated
I
what. Now I have tried to tabulate what essentially we have discussed till now. But yes, but this resident, consider an employee who is resident in India. We have two clauses. One is that where is the employer based and where have the services been rendered. Do keep in mind it's an employee resident in India. So whether it is received wherever, it doesn't matter. In that case, it will be always. So now we have employer based in India, services rendered in India, fully taxable in India, no questions about it. You have an employer based outside India but services rendered in India. Taxable in India because his worldwide income is liable to tax. But credit of foreign taxes may be difficult to get. And the reason is that because you have services which have been rendered out in India and your employer who is based outside India. If there you have paid taxes, you have rendered services in India. Frankly, India would say that you have rendered here, why should we give credit for any taxes you have paid outside India? But if that be the case, then you have to fight out that case and see where it takes. But credit to me looks difficult. If your employer who is based outside India, your services also rendered outside India. Now you have a resident of India whose services have been rendered outside India, then he is taxable again in India on a worldwide basis. But credit of foreign taxes should definitely be available to him. Now employer is based in India, say take an example of something like an Infosys. You have an Indian resident who goes outside India on deputation or not on deputation but he is gone for a project and come back. Then you are taxable again in India as well because of the worldwide income, and here again credit of foreign taxes should be available to you. That should not be an issue. So that is as far as resident is concerned, it's much more on the credit of taxes, not per se on whether it's taxable or not. Because he is generally going to be taxable in India because he is a resident. But you come to non-resident employee, there you also have the fact that where the salary has been received. So there are three columns here. You have an employer who is based, you have an employer who is based in India, whose services are rendered in India, and salary is received in India or outside India, doesn't matter. He is still taxable in India. Credit of Indian taxes should be available in the country of residence because he has rendered services in India. He may be taxable here. That credit should be available there. An employer who is based outside India, but services are rendered in India, again taxable in India only in respect of the services which have been rendered in India because his employer is still based outside India, subject to short stay exemption. So whatever is available to you as a short stay exemption would be available to you as a relief. Now you have a third situation is an employer who is based outside India, and this is where it starts getting interesting. An employer who is based outside India, services which have been rendered also outside India, salary also received outside India, definitely not taxable in India. But you have received that salary in India in that same year. Now imagine a foreign, an employer who is on a foreign ship, take that example, he is an employer who is based outside India and his services also have been rendered outside India, but the salary has been received in India in that same year. As we discussed, on the first receipt basis itself will be taxable in India. But if the salary is received in India but in the later years, take for example an ESOP kind of situation where his employer was based outside India, his services were rendered outside India, he retired and came back to India, or he resigned from that employment, he is now in India and he is earning ESOP income from that salary based on his services which are rendered outside India. To my view, it may not be liable to tax in India, and if it is not liable to tax in India in the year of accrual, it will again not be taxable in the year of receipt. As it has already been subjected to tax, though not liable to tax in India, it has already been covered for tax purposes. This, while we are talking about domestic tax law, it is a controversial point, When it comes to double tax avoidance agreement, it becomes very much simple because this is what happens then. But on the domestic tax law, it is a controversial point, even I would admit so. Not many commentaries, hardly any commentaries you will find where this point is actually mentioned. You have an employer, a non-resident employee whose employer is in India, services have been rendered outside India. There it does not matter whether it is in India or outside India where the salaries are received. As we discussed that it will be taxable in India as the employment base is in India, which we already discussed at length earlier. So this is what I have tried to tabulate. International hiring out of labor, here the key area of concern is that what do we mean by an employer? When you have an Indian resident entity which actually enters into a contract with a, as we say, the kind of entities which actually give just people, they give to do the placement part, they essentially tell you that okay, you need 30 engineers for a project, we will supply those 30 engineers. Those 30 engineers will be on the payroll of the foreign employer, but they will be working on the instructions of the Indian resident entity. Now where do you go to state that what is it, where is the taxability of this area? Then you come to that who is the employer essentially. And there are several examples which are given in the OECD commentary itself, that okay, who would you say is the actual employer? Some key areas or the key factors which one can keep in mind is one who bears responsibility and risks of employees, one who directs and supervises the work of employees, or one who enjoys the fruit of the employee's work. These are the three basic criteria which one can go to determine who that employer is. Then there are several OECD examples. Then whose work is the employee doing? That also becomes very important. Is it the integral work of the lending company or the borrowing company? So what happens is when you have an entity which actually just keeps on hiring engineers, but it itself has no engineering activity. Okay, and it just gives out its own employees to others, to companies who actually have those engineering activities. Then you go to see that whose work is the employee doing? Is it the integral work of the company which actually sent him? No, because that company actually does nothing other than actually taking people on payroll and then supplying them to different clients. But yes, the client with whom they are working now, they are actually using their skills for the work of that client. So again, that also becomes a key criteria to determine who is actually the real employer. Frankly, I am just giving this as universal kind of principles because there is no state law to say that, okay, or state ground to say that this is the case. It's a very, very factual scenario. You have to look at the facts and you have to see that where exactly who is supervising, who is dictating, who has the hire and fire kind of powers for those employees. So several of those areas will go into. Just to read from Claus-Vogel's commentary, it says an employer is someone to whom an employee is committed to supply his capacity to work and under whose directions the latter engages in his activities and whose instructions he is bound to obey. So a key consideration will be the enterprise which bears the responsibility or risks of produced by the individual's work. Now in a case where there is a company which actually just gives out people, engineers or several other qualifications of people which they will actually give out, they would generally not be bound by what happens by that employee's work. It will be actually the client who is actually taking those people on hire. They will actually be responsible for whatever that person does in most of the cases. If that be the case, again, that would determine who the employer is. That would be the client and not that person, the employer which is actually having so many employees on its roster. So all these kind of key clauses of the agreement will go into the fact and the situation on ground. Who is actually dictating? You may just write that, okay, I need 5 employees, then they will send you 5 employees. No, you will say, no, I need 5 employees of so and so caliber, I need of so much of experience, I need them to be specialized in so and so skill set, and I need them. And if tomorrow you say that, okay, this one person is not fit or is not doing the work as I wanted, please send him back and replace him with somebody else. All this kind of clauses, who is actually determining? If that be the client, then yes, then he is actually the economic employer for that person. There are several decisions or precedents in that case. IDS software, HCL Infosystems are not cited in the many cases, but the point which I wanted to bring out was what are the base principles for these. I'll skip the next few slides, they're not very, frontier workers is a very rare case. ESOPs, coming to ESOPs, you have to essentially distinguish the employment benefit from the capital gains. Gains up to the exercise of option is salary income. That is, as far as even Indian tax is concerned, ESOP is what we have understood, it's a perquisite benefit which you are getting when you are paying something less for what you are otherwise getting. So when you are exercising those options, you will be liable to tax on the perquisite portion of it, which is nothing but salary income. But once you exercise and you got those allotment of shares and you sell them, the gain which you make is a capital gain. Just to kind of bring out, so from option, granting of option, so there will be several times, several points of taxation probably, and mind you, there are countries which hold different views on when to tax it. Even India has changed its view on the same issue. So you have an option which is time of granting of option, vesting of option, exercise, allotment of shares, and then finally eventual sale of shares. Now out of all these options, to granting of option to allotment of shares would be perquisite and taxable under Article 15, and on the actual one, once your shares allotted to you, will be the capital gains taxable under Article 13. Again here, the only key point, one more key point we should keep in mind is that what happens on the appreciation of value. So you have an exercise of option. This I am not talking about granting and vesting. I am saying you have exercised the option. Once you exercise the option, you are still in country A. You have got allotment of shares, and then you have left that country and come back to India. Now you have sold the shares. Now what happens in the capital gains is that they don't look at the fact that where is the appreciation value happened. It is not like salary income where you say that where have you exercised your employment. That doesn't matter. As far as capital gains is concerned, it will only be that whatever is the gain you have made, so A minus B, whatever is the gain you have made, that simple is brought to tax fully. So your full appreciation in value, whether that appreciation happened in India or outside India, will still be liable to tax in India. That has to be kept in mind. Is it for future or past employment? Frankly speaking, it depends a lot on the ESOP conditions. What are the conditions on which you are granted those options? We have seen cases where they will be granted for 2 years back. Have you worked for 2 years back? Are you going to work for 2 years hence? Are you going to supply, kind of linked to the performance, not linked to the performance? There will be several such conditions. It all depends on exactly what those conditions are, and that is what will determine whether it is for the future or the past employment. But why are we coming into this question at all? We are coming into this question because if it is for the future employment, you will consider that total part as where have you served that service. Where have you served that service period which is under consideration for ESOP taxation. If in that portion of it is rendered in India, only that portion will be liable to tax in India. The balance portion will not be taxable in India. How do you do the division? You can go any which ways. There is no ground rule. You can go, generally salaries monthly, you can go by ESOPs also by how many number of months you spent in India, how many number of months you rendered outside India, services rendered outside India. Leave salary also to a certain extent is similar to that. It is leave salaries for periods not utilized. Definitely ESOP is an incentive. Leave salary is something which forms part of the salary income, but it has not been utilized. We already discussed this point slightly earlier. Income accrues during the period of service and not when received. You may receive it at the end of your period or after termination of employment. It is still accrues during the period of your service unless your employment terms actually dictate something else. They try to say that something else, they will say that leave salary is only a lump sum computed on some ad hoc basis, like say last 10 months of salary. If those are the kind of issues, then yes, you will have to consider that only those last 10 months. Otherwise, leave salary, if you can bring out that, these are my leaves. During so many years, these were the leaves which I have taken or not utilized, and if that table is available with you, then it will depend on where you served during those periods. I am not taking this case study, we have already discussed it in part earlier also. Again, tax equalization and hypothetical tax. In a sense, there are methods designed where an employee is location agnostic. It does not matter to him as far as where he is deputed to, as long as his tax is taken care of. If he is going to be put into, say, from something like Singapore to India, he will have a heartburn because he will be paying more taxes in India. Now, how do you do that? How do you save him from that? You try to do it by equalizing his tax in a way that you try to say that, okay, whatever your tax outgo was in your home country in Singapore is what maximum you will pay in India. You will not pay more than that, and that is what hypothetical tax also in a way means. There are different ways to compute it, different or rather many various ways to compute it. But the whole idea is, as far as we are concerned, is whether it is deductible or not for that income of that employee. In a sense that an employee, when he receives an hypothetical tax, it is deducted from his salary. What they say essentially is that we will compute a salary as if in our case based in Singapore. You earn that income as if you are based in Singapore. If your tax in Singapore was 50,000, we will consider that as a deduction from your salary, and then we will pay your taxes in India or Singapore, wherever or howsoever it may be, that we will pay, we will take care of that. Now, whether that amount is your income or not, that has been debated. There are few decisions, Yoshio Kubo, Jaydev Raja, Dr. Percy Batliwala and others. what these decisions, I'm not citing each one separately, but they have stated that the income arising in India in the present case is actual salary plus the incremental tax liability arising on account of Indian assignment. Hypo tax never accrued to the SSC and thus is deductible. Very frankly, I don't know where exactly, because they have tried to take from accrual principles from ED, Sassoon and company. I am not very clear that how you can apply those kind of principles here, because frankly speaking it is still part of your salary income. But fine, you can say that it is not come to me at all, it is something which is my tax. But in a way you are still, it is finally all of us are paying taxes on our salary income. We don't say that, no taxes, you don't levy tax on what the tax portion of my salary goes towards. That we don't say. But so, anyways, these are some of the decisions which have held so. Social security contributions, I think you had that point about the employer should be authorized. So compulsory or mandatory in nature or not, the employer should be authorized to deduct the social security contribution from the monthly remuneration payable to the employee. Contributions are required to be made by all employees compulsory or not, and are there certain penal implications for the default or not. So all these actually come into nature whether it is compulsory or mandatory or not in nature. If there is no vested right or not, that also becomes determination of whether it gets taxable as a social security contribution or not. You had a question on that, right?
Non-mandatory contribution for wage expat employees, those are taxable.
Non-mandatory, definitely I would feel that it would be taxable. Because if they are resident of India, then whether it is mandatory or non-mandatory, whether it is, you are saying that of your own choice you are making some social security contribution, then frankly speaking it is still your application of income in a ways. It is salary income, you are applying it to go towards a social security contribution or not, that is your choice. In fact, this issue, to take it slightly differently, is in all 401k cases. A lot of US employees who have returned back to India, they have still maintained their 401k accounts, which are in a ways kind of a provident fund, or loosely said, kind of a pension fund which they would earn when at the age of 59 or something, when they would be allowed. But the problem in 401k accounts is that you have a choice of where that fund goes. You can determine down to the straight shareholding where you want to hold those investments in. So in a ways it is still in your control, fully in your control rather. The only downside to it is that if you take out that money, there is a penal tax on it. In a sense, you will pay some 20 or 30% tax, only then you can take it out before the age of 59. So the problem here is that can you still say that no, I cannot get access to that money, or don't have access to that money, or do I not earn that income? Frankly speaking, you earn that income. Every year increment is actually an earning of your income on it. Every year what you earned on it, the dividends and the capital gains, frankly it is all your income and it's taxable in India. And that is not a view which, again there can be two views about it, as there can be for everything. But the point remains is that in my view, on a conservative basis, yes, there is a taxability in India. In fact, I think these questions were posed when the Black Money Act, there were some FAQs which were issued. And there also the department has also held a view that 401k accounts which are held by citizens, which are held by Indian residents, they will be liable to tax, not for the portion which has been earned when they render services outside India, but once they become resident, every year they are earning some income. That portion will definitely be taxable, and in fact they had suggested that you should submit and disclose those assets in India. We have social security agreements now with almost 18 countries. Essentially they are not per se with respect to remittance, but the only idea is that you may end up, if you are in that exempted, so it is obviously now applicable to international workers. Our own provident fund contributions are applicable to international workers. But when you have a social security agreement, you may not end up paying social security contributions in both states. In your kind of a case, if France had a social security agreement, if in France they were already paying social security, then India could have exempted them from not paying in India again.
So India they are not paying, they are paying in France.
Okay.
France they have mandatory as well as voluntary type of contributions.
Right.
So while computing their taxable income in India, whether they should factor those non-mandatory contributions.
I would feel so that it should be counted. But frankly speaking, still I would have to look at that employment agreement or whatever is that status, because frankly, when you look at certain kind of social provident fund contribution rules, is it a company frame scheme or is it a scheme which is there by the government? What is it exactly? That has to be ideally seen, and based on that also you can determine what is the taxability. Pension income, I think I am skipping it right now because kind of straightforward. The only concern that one should always keep in mind is that there can be different kind of, so government pensions and private pensions will always be treated differently, please bear in mind. You may end up, we have a case where a person is being taxed in India on the private pensions but not on the government pensions, and that includes even something for a library where she was working for. So this kind of, or a museum where she was working, that was also of the government. Therefore her pension which is on from there is not liable, but a private pension becomes liable. So be careful on that. Now just a couple of slides more on the deduction of tax at source. When we come to salary, 195 has no role to play. It clearly mentions that whatever is income under that, salaries will go under 182, and 192 will determine how that tax has to be deducted at source, which means that under 182, as for all of us, salary income, how it gets taxed, it's simple that it has to be based on your slab rate, the rates in force, which determine your advance tax, how you would compute. In that similar fashion, the employee's estimated income for the whole year has to be computed and then brought to tax in India. It is deductible on payment basis, so be very careful, like that example which I gave of March and April. There has been one case where March and April and they have to pay on payment basis. March salary they paid in April. Now for which year's Form 16 will they include it? So these kind of issues can happen, but they are rare, but they do happen sometimes. 20% rate will be applicable if no PAN is available. Strangely, there have been cases in which have gone up to, I think, High Court level where the employers don't have PANs of their own employees. So, but this was at the start when the 206AA came into play. Can DTAA relief be considered while computing TDS? In my view, yes, completely, especially the short stay exemption. If you are not liable to tax in India, definitely you are not going to say that no, first let me pay and then claim a refund. I would not believe so. But foreign tax credit is another question altogether. If you have a person who has, say for in your kind of an example, that French person has come to India as a resident of India, but he has paid some foreign taxes outside India. Now can he claim those foreign tax credits while computing? But can the employer consider it while computing his tax outgo in India? I would feel so that you cannot. He may end up paying higher tax in India and then claim separately his foreign tax credits, but that's still, meaning while cumbersome, that is the right way to go about it. Person responsible to deduct tax at source is obviously the employer. Only key area which you have to keep note of is the LELD decision of the Supreme Court, which says that Indian employer will deduct tax at source on salaries received by foreign expatriates deputed to it, even though the portion of the salary is earned outside India. Frankly, this is a very, meaning this, the law clearly stated that the employer is to deduct tax at source. If you consider that the Indian employee, the foreign expatriate was liable to tax in India, the foreign employer technically has to deduct tax at source and submit to Indian government. But here the Supreme Court went one step ahead and said the Indian employer where they were deputed, he has to deduct tax also on the portion which is received outside India. This has very practical repercussions. We have seen employees who are not wanting to disclose what they are earning outside India. When they are deputed from outside India, they don't want to say that how much they are earning outside India or what portion of salary they are earning outside India. But unfortunately, Supreme Court is the rule of the law of the land right now. And employer has an option to pay tax on non-monetary perquisites without TDS. There is an exemption under 10cc. Obviously, these are compliance forms. There is nothing new about it. Consequences, again, there are two key consequences one should keep in mind. Employer who is deemed to be an SSE in default, for example, he has not deducted tax at source or he has deducted or he has done a shortfall, he is considered as an SSE in default. Now there have come out a proviso where they have exempted but only resident employees who pays up the tax on his own, and then you file Rule 31, under Rule 31 ACB, you file the Form 26A, then the employer is not deemed to be SSE in default. This is only for resident employees. To my understanding, Hindustan Coca-Cola Beverage, a Supreme Court decision again overrides it when it says that if somebody has already paid tax, you are not supposed to then again ask the employer to deduct tax at source. I would feel that that will apply equally to even non-resident employees, but frankly right now the exemption in the law is only for resident employees. Still, whether you are an SSE in default or not, or if you are not an SSE in default, your interest outgo may still remain even in that case. The other, okay, there is a very recent decision where it says that whether an employee is to pay interest under 234B and 234C. It was a case where they were not able to determine whether it is a salary income itself or not. So that got decided by the High Court by saying that yes, it is salary income, but you are liable to pay 234B and 234C advance tax interest because you are not paid, tax has not been deducted at source. The Supreme Court has come out with a ruling saying that no, under 182 it is the employer who is liable to deduct tax at source, and therefore once an employer has not deducted tax at source, it does not mean that an employee has to pay advance tax, and therefore 234B and 234C will not apply. To my feeling, I don't know, maybe it's the Supreme Court when at the end of the day, I am in no place to comment on it, but frankly speaking, it does feel that yes, you are still liable to pay under advance tax scenario, but there is a Supreme Court decision which says otherwise. Remittance of salary, generally salary is paid in India by the employer in most cases, but direct remittance itself is possible. You can look at FEMA notification 10, the revised notification regulation 8. There are specific cases where you are allowed to remit it outside India. What do the banks insist on? Frankly, I have tried to search out, and I have, meaning from my feeling, first and foremost, 15CA and CB actually do not come into picture because they are under 195, not under 192. But there is no other recourse. Banks do ask you for that. Most of the banks will ask you to give a form 15CA and CB. If not that, then what else? I have heard that somebody is saying that they give an employer's certificate stating that the taxes have fully been paid, or another is a board resolution stating that okay, this much is the salary income of that person, therefore you are allowed to remit it. To my ground, there is nothing very concrete around this, but you have to go to the bank and probably get from them what they want exactly. There are some other areas of concern, the change of resident. We have discussed about tax residence, we have not discussed about FEMA residence, which is also equally important. In my view, once you are an employee who comes into in India, he becomes resident under FEMA from day one. There is a different view also, but to my understanding, if he becomes a resident of FEMA from day one, can he actually open bank accounts in India and do transactions in India. So by whatever way you read it, it should ideally be that he should be a resident under FEMA from day one. There are certain exceptions for not permanently resident who can actually hold foreign currency outside India. So those kind of exclusions are there for employees who are here only for a short period, say up to 3 years. What happens about foreign incomes received abroad? Once a person becomes a FEMA resident and any income which he earns newly outside India, there is a question whether it has to be brought into India or not. If you strictly read the provisions, then if it is out of assets which are there already existing before he turned resident, then he can still retain them outside India. Any incomes he earns, say he has a house property, earns rental income from it, he can keep it outside India. He does not need to bring it into India. Other than that, if he earns say some kind of consultancy income when he is actually a resident under FEMA, then very strictly he has to actually bring it back into India. He cannot retain it outside India. Unfortunately, now the FEMA Act itself has been amended to make it very, very severe penal provisions for assets which have not been, or rather assets which are undisclosed and lying outside India. So you have to be very careful under FEMA also. Filing of tax returns, we have discussed all this. Service fee for the employer can be there. So from the employer's angle, he has to be careful about a service fee. There is a G Energy Parts Incorporation decision, which I would suggest all of you read. It's very good. In a sense, they have said the tax office has gone on the LinkedIn profiles and seen what the employees have said, what they are doing here in India. Based on that, he has actually said that you have P in India. So you can be very, very careful. And anyways, tax officers are calling and interrogating all the key employees in India. So you should never be of that impression that no tax or what. How will the tax officer call you? They can and they do. Deputation and secondment agreements drafting is a very, very key, because if that is wrong, then your whole tax liability is skews. And there is a transfer pricing exposure for outsourced activities where cost plus method is followed, but you don't compute the salary portion in that cost plus method. But I'm not going into it, but it's a very rare issue. Thank you very much, and sorry for rushing the last part. Anyone else?
Friends, we'll all agree that Rutvik was given time X, he delivered 1.5x, surely because of his speed. Thank you, Rutvik. May I request Karthik to propose a